afternoon, everybody, and welcome to Essentials. For those of you that don't know me, my name is Dale Franklin. I'm an Executive Director for Anchor Financial Services, and it's a pleasure to welcome you today to what should be a really interesting session. The commodity cycle is defined as extended periods during which the commodity prices are well above or below their current trends. Clearly, at the moment, with the current Ukraine crisis, it's certainly at well and above its current trend. I'm going to have an easy job today. Hosting our panelists and hosting the discussion is Peter Armitage. Peter Armitage is the CEO for Anchor Group and the Co-CIO. Peter has been in the market for many, many years. Peter, I won't embarrass you and say how many years you've been in the market, but certainly he's seen a few commodity cycles. I'm going to allow Peter to introduce James and Seleho. Before I sign off, please do try stay on for the full hour so you do get allocated the full CPD point. Thanks very much. And with that, I'm going to hand over to you, Pete.
Great, fantastic. Thanks, Dale, and welcome to all of you. I still find it fascinating. We can sit and talk to hundreds of people sitting from our room, and I have the pleasure of having James and Seleho with me today to talk through the commodity cycle and how it works. So we've got, I'm not a commodity expert. I've been buying and selling commodity shares throughout my entire career, probably making and losing money in equal proportions. But we've got James, actually was the #1 resources analyst in the market for quite some time, working at UBS, part of their global team. And Seleho, many of you would have experienced in the Anchor team. He's covered resource and commodity shares for, I don't know how long, Seleho, probably six or 7 years. Yeah, quite some time. So some very learned gentlemen who are going to share all the secrets. And we're going to start off, let me just... I think just to introduce it, just to remind people that you don't make money out of commodities all the time. And I thought I'd just pull out the Anglo-American graph. You can see back in 2016, the share had gone down 38% over 12 months. It was a big call whether to bail out of it or buy. You'd held on to it, you went up 1,500%. You can see along the way lots of volatility. And more recently, the commodities have been absolutely smashed, down 38%. So what we're going to do is try and help you make sense of what commodities mean when the opportunities arise. And there's nobody better placed to give us an introduction to that than James.
Sure, right. Great, thanks, guys. So just thank you very much, Pete. A quick introduction. My name is James Bennett. I've been in the market since 1994. I covered diversified mining at UBS for about 20 years, and then I did about 3 years at Citi. In more recent years, I look more at just general global mining companies, but I still have that sort of long institutional knowledge on how to think about these miners. Right, so let's kick off. The first thing we always used to say with miners is you don't buy them, you rent them. These things are very cyclical. As Pete was saying, you've got to trade in and out of these things sometimes, and they can bite you quite fast. So at Anchor, we sort of think about ourselves as quality growth managers. We look for asset-light companies, high margins and a high return on capital employed, not just in one peak year, but on a through-the-cycle basis. And I think it's fair to say that as a general rule, the miners struggle to fit into that quality growth camp. And what I'll talk about a little bit right at the end is that obviously if you're a global fund manager, where mining is a very, very small part of your universe, you've got the luxury of mostly just ignoring these companies and only buying them once every few years. Obviously, in a South African context, we don't have that luxury. And, whether we like it or not, we have to take these big calls on that sector. Now, let's think of some examples why I say these miners don't really fit into that quality as sort of growth camp. Now, imagine I said to you, you can buy the share called Pick n Pay. Okay, this company has got 100 stores, and they'll be shutting 5 stores down every year for the next 20 years. such that in 20 years' time, you don't have a business left. You might still buy the share, but you'll be a lot more careful about what you pay for it, and you'll really know what you're getting into. Now, in a sense, that's kind of what we get into when we buy these mining companies. They've got a finite resource. You deplete that over the life of the mine, and you're basically left with nothing at the end. It's also a very capital intensive industry as well. And that sort of capital intensivity tends to be sort of hidden more off the income statement in the cash flow. So you spend these billions and billions of rands and dollars building these mines, and then you slowly depreciate them through the income statement every year until eventually you've depreciated them down to nothing. Bear in mind as well that when these companies build mines, they tend to always mine the best bits first. So you go and sink your shaft where you know the grades are the highest, where you know the grades are the most consistent. Your haulage times are short in the first couple of years. And as the years go by, your grades start to fall. They start to become more variable. You know, the steam starts jumping around all over the place, and your haulage times start to get further and further to get the ore back to the shaft as well. So these really are, you know, very, very difficult companies to run. The other thing as well is that when you look at the financial statements of these companies, in the cash flow, there are always these two lines, what they call maintenance capex and then growth capex as well. So your maintenance capex is what you have to spend generally just to keep your operations running. And there was always a bit of a gray area with these mining companies where perhaps some of the things that should have been expensed through the income statement just go through the cash flow in sort of so-called maintenance capex. But what's interesting with the growth capex is that, and we did many studies on this over the years, where these companies would have spent, you know, hundreds of millions of dollars on so-called expansion capex, and yet 10 years later, they're still producing exactly the same amount of tonnage that they were 10 years before. So was that really expansion capex? Or in the case of these miners, is that really just the case of running to stand still? So again, these all point to these reasons why I say typically these companies don't really fit into that sort of quality growth camp. And then when we look at these mining companies, I mean, there's really four key drivers of a mining company's earnings. It's dollar commodity prices, production volumes, the producer currencies, in other words, for example, the rand and the Australian dollar, and then your local currency operating costs. And I mean, the evidence on that is absolutely unequivocal that the single most important thing is and always will be when you invest in these companies is your dollar commodity price. On the currencies, people say, well, what about the rand? But remember that the rand and the Aussie dollar are often that sort of second derivative of what the dollar commodity prices are doing. So often when you go through one of those periods where the rand is weakening, often it's doing that because dollar commodity prices are falling. And it's the other point I make as well, is that in these commodity companies, you seldom get a free lunch with the producer currencies. You know, they're normally moving for a reason and often counter to the commodity prices. So when you have one of those periods when commodity prices are going up, invariably it's a period in which the producer currencies are strengthening as well. By far the smallest of the four drivers of these companies, and I'm talking especially big established, you know, diversified mining companies, not maybe just a small startup, is your production volumes. It's a very, very small driver. It's not even the icing on the cake. It's the cherry on the icing on the cake in any 6-month period. And bearing in mind that often that growth is also just replacing, you know, something else that's actually falling away. And then the fourth driver really comes to costs. And it comes back again to this whole thing about the, you know, the quality growth argument, is with mining companies, there is so much that is outside of management's control. There is nothing these guys can do about their commodity prices. Volumes, they can have a little bit of an influence on, but again, it's a small driver. It's a case of running to stand still. There's nothing that they can do on the currency. So the single thing that you're really rewarding management for in these companies is the ability to control costs. And remember that controlling costs in a mining company is extremely difficult, even at the best of times. And even with a good management team, you can sometimes really run into problems. And one of the things that the very good global mining companies have identified basically decades ago is that if you go into the wrong assets in the first place, your ability to control costs becomes literally zero. And one of the key things there, and this is where SA mining has really struggled over the decades, is the difference between open pit mining and underground mining. And the problem with South Africa is that historically we always had a very sort of high level of deep level hard rock underground mining. It's terrible working conditions. It's very, very labor intensive. And so what BHP and Rio said many years ago is we do not invest in mines that have to go underground. So if you look even to this day, you'll see that Rio and BHP have the vast majority of their earnings coming from open pit mining. Now, it doesn't always work out like that. Sometimes it is what it is. You've got an asset and you own and it's underground. But I always think for the mining companies that you are going to own longer term, it makes a huge difference if you're in these open pit mines. And if you think of these open pit mines, the very, very low labor component. So for an underground mine, typically about 50% of your cost is labor. And it tends to be a very sort of low level labor as well. It's picks and shovels. These guys work in absolutely terrible working conditions. It's very, very difficult to sort of crack the whip with the guy who's earning something that's not a much above the breadline, and it's awful working conditions. These big iron ore open pit mines in Australia that BHP and Rio run, I mean, these things almost run by themselves. The guy gets into a big 30-ton truck, he takes his sandwiches with him, drives down into the pit in his air-conditioned cabin, and away he goes. So I always think within one's mining exposure, you want to invest in these things where at least management have some control as well. The other thing to bear in mind is that often we have to be careful on the bull case for some of these commodities. I mean, this doesn't always apply, but it's just something to bear in mind, is somebody will say they're a bull on a certain commodity, and you say, well, why are you bullish? And they say, well, the companies have got production problems, their costs are out of control, things are going badly in the industry, there's no material coming out, so therefore prices are going to go up. So that's all fine if you were just somebody buying the physical commodity. Just remember that when you invest in these equities, sometimes you're actually investing in that problem yourself. So sometimes a little bit of what you get with the commodity price gets taken away by the operational difficulties with the company that you're actually investing in. The other thing I'll just say with these miners is that over the years, hedging has really become a bit of a swear word as well. And in fact, Marius Kloppers, who was the previous sort of ex-South African CEO of BHP, had actually declared hedging a thought crime at BHP. So in other words, what he said is, if we even catch you thinking about hedging, we'll fire you. And it's really this argument that these companies just don't have the ability to time these things. You invest in a company because you think commodity prices are going up, they do, and you find in the end that they've just hedged it away. So generally the track record on that is poor. So you want a good company that doesn't believe in hedging, that's got a lot of open pit mines, and that certainly increases your chance of getting a better return. If we just sort of pivot back then to global mining, I mean, the thing that I really can't stress enough is how important iron ore has become as a driver of the global sort of mining story. Now, there are obviously individual stocks in a portfolio that you can pick to pivot away from that. But if you're just looking at the big picture as sort of seen, iron ore really has become ultimately the make or break of the global mining sector. So back in 2005, iron ore was sitting at about 20% of global mining earnings. And how I define global mining earnings is sort of the big five. So that's Rio, BHP, Vale, Anglo American, and Glencore. And in the case of Glencore, they don't have any iron ore exposure. But even with them in that base, iron ore was about 20%. By about 2016, iron ore had got to 90% of global mining earnings. So it really had kind of become the iron ore versus everything else trade when you bought these big global diversified miners. And even today in 2021, that number's probably sitting at about sort of 60 or 70% of these global mining earnings. Now, the key thing with that is that iron ore is driven almost exclusively by the China story. So when we think about mining and commodities, we've got to think a lot more about China than we think about the US. So there's probably very few, if any, commodities out there where China is a bigger percentage of global demand than is the case with iron ore. So where we are today, China is about 70% of the global seaborne traded iron ore market. In other words, not the captive iron ore that sits in a lot of countries that just goes down the road to the local steel mill, but actually the actively traded iron ore that crosses the water, most of which comes from Brazil and Australia. So if you get that call right, you'll get the big global mining call right. And again, that's all driven very much by China. If we look at the US in steel, about 70% of domestic steel production in the US comes from what's called the electric arc furnace. Now, your iron feed into an electric arc furnace comes from scrap steel, not from iron ore. So the US as a country is not a big consumer of iron ore at all. I mean, they import almost none of it. And that remaining 30% of their iron ore requirement basically is captive iron ore that comes from their domestic producers. So, you know, this whole commodity story is very much a China story. For many years, we worried a lot about iron ore being a very sort of oversupplied market. Bear in mind that iron ore is probably the second most plentiful commodity known to man after bauxite. In other words, it's almost easier to list the countries that don't have iron ore than the ones that do. But your real constraint with iron ore is not the resource base. It's ubiquitous. It's absolutely everywhere. It's the physical infrastructure to get those tons into the market. These mines are usually a few hundred kilometers from the port. So you've then got to build a whole lot of rail. You've got to buy a whole lot of rolling stock. You've got to expand the port, and then you've got to have the shipping capacity to get these hundreds and hundreds of millions of tons across the water into that China market. My sense is that oversupply risk, which everybody felt that there was kind of this D-Day that was eventually going to come for iron ore, where it was going to be oversupplied. I think the market seems to have been able to absorb a lot of these extra tons. So I think that supply risk has probably abated quite a bit, and it's now probably more just a demand risk from China when that sort of steel curve eventually rolls over. Now, the demand for steel typically follows sort of an S curve, where if you look at the relationship between steel consumption per capita and GDP per capita, you eventually get a point where when your GDP per capita goes above a certain point and your economy is being developed, your steel consumption per capita actually starts to fall off a little bit. And there's no doubt that at some point in the next few years, China will reach that point, and then we'll probably see this iron ore trade start to roll over. And that certainly won't be great for the global mining sector. There are some, just tilting away from that, there are some unique sort of trading opportunities that these mining companies give you. And one of the very key ones is these net debt situations. Now, I think our general view would be that generally buying companies that are drowning in debt, sort of industrial companies, is typically pretty fatal. The companies just can't trade their way out of those problems. They either end up having to sell assets or to do rights issues, and you just lock in the share price at that new level. But what I've always say to people is that if you are going to trade one of these high sort of net debt, low equity type situations, your best chance, not always going to work, but your best chance of getting that right would be in one of these mining stocks. And we've seen a couple of very good examples of that in South Africa over the last couple of years. And the two that I would give would be ArcelorMittal South Africa, which was the best, a very, very low quality company, but it was the best performing share in the JSE last year. And then obviously Sasol at 18 Rand a couple of years ago as well. Obviously, these things are easy with the benefit of hindsight. But what makes this cyclical commodities businesses different with these high debt situations is that if you're an industrial company, going back to my Pick and Pay example, and you're drowning in debt and you're in trouble. You can't go to your clients and say, look, we're just going to up our prices over the next year or two by 150% just while we trade our way out of this debt situation. And then when we got ourselves right, we'll drop our prices down again. But often when these companies are in these terrible net debt positions in the cyclical companies, it's when the underlying prices are very low. You suddenly get 150% move in your underlying price, and you very quickly traded your way out of that situation, and you can get absolutely outlandish returns in times like that. So in the case of ArcelorMittal SA, I mean, they were almost bankrupt at 34 cents in 2020. Their forward earnings for calendar 21 that the market didn't realize at the time was R6.15 per share. So that company basically, after almost being bust, generated its entire net debt in 12 months with a cyclical recovery. And, Sasol, with its $10 billion of net debt a couple of years ago, obviously they sold some assets as well, but for the most part, they've really been bailed out by this massive cyclical recovery in the oil price. So that's one very unique opportunity that things with cyclicals that you would normally never, ever do with industrial type of companies. And then again, back to my comment at the beginning with these companies that you don't buy them, but you rent them, you do get some very, very nice cyclical trading opportunities in these companies. Now, those cyclical opportunities comes back to that old mantra of, you sort of buy these companies when there's blood on the street. So in my career since 1994, I would say there's three sort of phenomenal, once or twice in a lifetime buying opportunities that has arisen in these cyclical miners. 1998, which was the Asian crisis. Thailand and those countries all got into a lot of trouble. These miners were absolutely dead and buried. I think the old Billiton, before it merged with BHP, ended up being a 10-bagger from that over a couple of years. 2008, the GFC also created a really good buying opportunity, and then a really superb buying opportunity, again, partly with the benefit of hindsight. It's never easy at the time, was 2015. I mean, that's where a company like Kumba Iron Ore had fallen from 650 Rand to 25 Rand. They had actually temporarily breached their debt covenants, but they got, again, hugely bailed out by the iron ore price. And within a couple of years, they were paying dividends higher than the entire share price was of 2015. Anglo American also similarly were on an absolute knife edge with their debt. They had announced this big program where they were having to sell at least a third of their assets. And in the end, they were able to cancel all of those sales. And, their debt was over $10 billion. And they were, again, massively bailed out by the cycle. The key point is, as we sit here in 2022, this is not a 1998, it's not a 2008, it's not a 2015. This is by no means a sort of a once in a lifetime buying opportunity. I always think with these miners, you sort of got to really invest in them on the balance of probability. Are your risks asymmetrically skewed to the upside or downside? Obviously, in those three periods I mentioned to you earlier, your risks were asymmetrically skewed to the upside. I certainly felt earlier this year when, these miners have done pretty well since 2015. I didn't think they were sort of raging sells, but it just felt like your risks were somewhat asymmetrically skewed to the downside. We've now seen this big sell-off, over the last couple of months. And where we are today, it feels like we're sitting a little bit in no man's land where you can sort of just as easily make a case for these things going up again 10 or 20% as to them going down 10 or 20%. So it feels a little bit more like a kind of a stock pickers market at the moment where you've maybe got to buy some individual shares. My final section that I'll just talk about then is that, in terms of what we should be doing on these companies at the moment, it always feels like there's a big difference between investing in these companies if you're a global fund manager versus being an SA fund manager. So at the moment, excluding energy, mining is about 3% of the S&P 500 index. So if you're a global fund manager, you probably share a lot of my views about these companies not really fitting into that quality growth camp. You can actually just, for the most part, afford to ignore the sector. You move on and you own all your other stuff. But maybe once every 5 to 10 years, the 2008 or the 1998 or the 2015 opportunity comes along and you take a 5% bet on mining. If it works out, you can end up having 15% of your fund, you sell, you move on, you come back again 5 or 10 years later. If you get it wrong and it never really worked out, you lost a couple of percent, and all is not lost. The problem obviously in SA is that we have no choice but to be very, very actively involved in these companies for a few reasons. The first and very, very obvious one is just that it's such a huge part of our market that even if you are negative on mining, you're kind of forced to always look at these companies and at least always have a view and always have a position in some of them. The second thing is that, we sit here in a small market. Our local economy is very, very tied in to the commodity cycle itself. So often what's happening in that commodity cycle and what's happening in these companies is quite heavily linked into SA Inc. as well. So one can never look at those sort of two, in exclusion to each other. The other thing as well is that maybe there's been a little bit of a decline in the quality of sort of the listed companies in SA over some time. There's been a huge reduction in the number of listings as well. So, and you do have some big international mining companies listed. Yeah, I mean, BHP is within its industry, it's a truly world-class, global business. So, it always has to at least sort of be, on your radar screen. So, yeah, I think that pretty much sums it up from my side. Just two things to say again as well. Just remember with these companies, there's never a free lunch with the Rand. There's always a reason why the Rand is weakening and strengthening. It's usually related to the commodity prices themselves. And broadly, yeah, it just feels to me like we're in sort of a neutral zone overall on these miners at the moment. And there we go. I'll hand over. Happy to take questions as well.
Yeah, thanks, James. I think that was an absolutely sensational summary of what's going on out there. Guys, if you've got any questions, if you just put them in the Q&A, we're going to spend a bit of time with Seleho now and maybe referencing James if he's got stuff to add. But I think it's a great summary of commodities, when you buy them, when you sell them, where we're at. But in reality, from a fund management perspective today, we have to decide, what we want to own and where we want to be. I think we've been very fortunate, and a lot of it at Seleho's insistence, to be invested in Thungela this year, which is up 233%. I think it's a classic scenario and one of those opportunities that James talked about, where a company that the prospects didn't look at all, but the coal price went through the roof. But Seleho, maybe you want to talk us through, when maybe just to add to what James is saying, the local market is about 30% resources. Yes. So Seleho is a very important person in our fund management team. So perhaps you want to talk about what they've done year to date, Seleho, and there's some more slides on how we're feeling about stuff.
Sure, yeah, Pete. Yeah, this table summarizes what the major resource companies have done year to date. And I suppose the point to make here is that most of the time, not always, but most of the time, it's more important, or at least as important, to get your view or your call right on the commodity as it is to get on the actual companies in those particular commodities. Because generally the subsectors tend to move together. So, the platinum companies tend to move together in terms of their returns, energy tends to move together, etc. And you can see that in this table here. Generally, energy has outperformed quite substantially. So that's mainly been driven by thermal coal and oil, which has done very well. Then you can see the next set of companies has been the diversified miners. As James said, diversified mining in South Africa and globally is mostly driven by iron ore. So that's been the major driver, or is the major driver of that subsector. And then finally, we have precious metals. That's been a bit of a difficult part of the market to be in. For gold, I think rising real yields has been the kind of the dampener on gold prices, although gold prices are always difficult to predict. And then for PGMs, it's really been a lack of, so PGM prices have been falling, and it's really been due to auto demand being quite sluggish. For most of the PGM metals, auto demand is kind of 40% of platinum, 80% of palladium, and it's really what happens in the car market is what drives demand for those metals. But generally, you can see that in resources, these companies tend to move together in terms of the subsectors. And so energy has really been the place to be. And we'll see that in the next couple of slides.
So let's see, looking at the commodity prices.
Yes, so this if you look at the column with some of the highlights, that column looks at year-to-date averages for this year versus what the commodities averaged last year. And the point to make here is that if you start at the top and you look at palladium and rhodium, which are the two biggest contributors to the platinum basket, those prices are down 9% and 16% respectively. And that's really what's driven the underperformance of the platinum companies, especially because, 9% and 16% might not seem like a huge decline, but these companies have a huge amount of operational leverage. So if your volumes aren't really growing, then a 9 or 16% decline really has a big impact on earnings. Iron ore, which we've already touched on as being very important for diversified miners, that's down 22% in dollars. And then base metals has done well in terms of the year-over-year averages, although base metal prices themselves have come under pressure recently from about June, as people have started to get worried about recession. But generally, you can see base metals have done better than, for example, PGM or platinum prices, which explains why diversified miners have generally outperformed the platinum companies. And then finally, probably the biggest story in resources this year has been energy. There's been a lot happening in the energy markets. If you look here, you could almost say that thermal coal is the new black gold. Thermal coal prices have hit record highs over the last year or so. API 4 today, I think, is at about $340 a ton. And this is really significantly outperformed all other commodities. If you look at, we don't have natural gas on this price, but natural gas as well has done phenomenally well. And really, it's been a case of the global coal market being caught off guard. So the thermal coal market's about 900 million to 1 billion tons in terms of the seaborne or export market. And what happened was, well, firstly, near the end of 2020, China banned Australian goods, the imports of Australian goods, because Australia supported an investigation into COVID-19 and China's role in that. And China obviously wasn't happy with that, so they banned Australian imports. And you can see Australia is the second biggest participant in the thermal coal market. But then Indonesia as well had supply issues, so they had excessive flooding, as did Australia, and so supply was weak there. And as we came out of COVID, demand really picked up, but at the same time, supply was lagging because of those factors. So even before Russia invaded Ukraine in February of this year, prices were already picking up and heading towards all-time highs. And when Russia invaded
to
Ukraine,
put that in context, Seleho, that was kind of $140, $150.
Yes,
so
yeah.
It was high, but then we saw a massive acceleration. But yeah.
Yes, exactly. You can see it there in the graph. And really that invasion kind of poured fuel on the fire, because Russia itself is a very significant participant in not just the thermal coal market, obviously, but also the oil markets and natural gas. But within thermal coal, Russia supplies about a third of Europe's thermal coal needs. And recently, or a few months after the Russian invasion, Europe decided to ban imports of Russian coal into Europe. There have been some stories that Russian coal has still found its way into Europe through blending, but for the most part, that ban, at least officially, has stood up. And so that's really added to the supply tightness that we've seen within thermal coal. And then to a lesser degree in South Africa, we've had our own issues with Transnet in terms of being able to get the export volumes that we would like at these prices. So essentially, thermal coal prices have really been helped by an almost perfect storm. We don't expect this. Sorry,
just while you're talking, it's just a question that came up on the screen. What is thermal coal? I think we assume that everybody knows what every commodity is. Maybe just give us a little explanation.
Yes, sure. So thermal coal is one of the major sources of energy globally. It's a fossil fuel. It accounts for about 37%, so just over a third of the world's global energy needs. There's thermal coal, and then there's metallurgical or coking coal. As a side note, interestingly, at the moment, coking coal is actually, the price of coking coal is below that of thermal coal, which is a very, very unusual situation. And some people are saying now that coking coal might start going into power generation plants, because the gap has just gotten to a ridiculous level. But thermal coal, yeah, it's a fossil fuel, and although it's very bad for the environment, but it's affordable. So about 70% of the world's thermal coal demand comes from China and India, because those nations are obviously growing and becoming economic powerhouses, and so it's an affordable source of energy for those countries.
But I think for thermal coal, think electricity, yeah.
So remember, coking coal is the second biggest ingredient you use in a steel blast furnace. So to make a ton of steel, you normally use about 1.5 tons of iron ore, and you use about 0.7 tons of coking coal. So coking coal's demand is very closely tied into as a steel making raw material.
But I think, also that, a basic that many people don't appreciate is Eskom's coal needs are largely met domestically, and export coal and Eskom coal are in two kind of completely different categories. The quality of coal for Eskom power stations, they typically have contracts with coal miners. Many of them are cost plus contracts. So the coal miners will, they'll be adding on 20, 30, 40% to the cost. And Eskom is buying coal in the region of probably 500 to 1,000 Rand a ton. There's some legacy contracts at much lower prices. But the mines with their higher quality stuff, which then gets classified as thermal coal, that becomes the export coal. So South African coal mines, the domestic mines supplying Eskom, are still making, they're not making super profits, they're making normal profits. It's the export coal where the guys, they were making 300 Rand a ton. They were selling the export coal at 1,300 Rand a ton. They're now selling it at 3,000 to 4,000 Rand a ton, or even more, Seleho. So, that's where you've got something like a Tungela, which got unbundled from Anglo's, when was it, a year or so ago, Seleho? It came out at 26 Rand a share. It's now 270 Rand a share. So, they're experiencing a cash waterfall and a once in a lifetime kind of cash flow experience. So, Seleho, I don't know if there's anything you want to add from a coal point of view, if you want to go through into Sasol.
Yeah, I think that's it on coal. We can go through to Sasol. Sasol's another interesting one. I think it got into the 30s during the depths of COVID. I think what's really interesting about Sasol at the moment, as James said, generally these companies aren't companies we would classify as high quality companies. But what's interesting with the Sasol story is they had that huge Lake Charles capex, which you can see in the top left chart there, where it peaked at about 70 billion a couple of years ago, and it's steadily been coming down since. The issue at the time was that there were overruns, and they put themselves into a corner in the sense that they had a very high debt load as capex was high, and there wasn't a lot of mistakes that they could afford. And so the market punished them heavily. But coming out of that, capex now, they've said, should be between 20 to 25 billion Rand per year versus the 70 that they peaked out a couple of years ago. And so free cash flow has actually improved quite materially, even before the improvement that we've seen in energy and chemical prices. You can see in the charts on the bottom left that free cash flow for the first time in the last fiscal year, so that's to June of 2021, was actually positive for the first time since, I think that's 2015. So it's about 6 years, the first time in 6 years that free cash flow was positive. And then as a result of that, free cash flow yields are now quite attractive. So for every rand that you invest in Sasol, you're now getting it's a 15% free cash flow yield. So for every rand you invest in the Sasol share price, you get about 15 cents of free cash flow back. And what's obviously made the story a bit more interesting is that energy and chemical prices are tight at the moment. And as James said, when companies have sizable amounts of net debt, it's not a positive position to be in, but it sometimes, if commodity prices go their way, it sometimes allows them to reduce that net debt quite substantially. Sasol's done that through a combination of earnings and selling off assets. But it's a company that, although it doesn't fit our, let's say, quality and return on capital boxes, looks interesting in terms of where it is with regards to its balance sheet and its CapEx requirements. So we think it's in quite a different position today to where it was a couple of years ago in terms of the risk profile.
With the oil price where it is currently, Sasol would probably make, 70, 80, 90 rand a share.
Exactly.
Sitting around the 350 level. So, these things are trading at very low PE multiples. So you make your money back quite quickly, as you say, 15% plus free cash flow yield. Does this imply, and James, feel free to add, does this imply that the oil price is high and has to come down quite significantly? Because if oil was sustained at these price levels, you'd certainly be filling your boots with Sasol. We do like it. We've got it as a buy, but it's, very, as James said, a very different scenario to, this is about getting a, 20% return. It's not about believing that the thing's going to double like it has in the past.
I mean, this sort of low PE thing with these mining companies towards the top of the cycle always becomes quite tricky. I mean, there's always that thing that you just generally with miners that you buy them when they're expensive and sell them when they're cheap. And for people who don't understand what I'm saying, the argument is that at the bottom of the cycle, you've got no earnings in a lot of these miners. So the E is very low. So, you've got your share price, which is also fairly bombed out, but divided by an E, which is almost zero, and you're sitting on a 200-300 PE. So if you just open the old proverbial newspaper, it looks really expensive, but you really need to interpret what is actually in that E, in the 300 PE. And then when you go to the other thing, you get to the top of the cycle where sometimes these miners look seductively cheap. You're sitting on a 5 PE, high dividend yield. It looks cheap, but what the market's saying is that it doesn't think that E is sustainable. And I mean, just as really an aside, we were sort of having a little debate on that on ArcelorMittal essay in the market today, in the office today, where, they came out with their half-yearly earnings this morning. You just take that 6-month earnings, you annualize it times by 2, and it's trading on a trailing PE of 1 times. And you sort of know, well, okay, steel companies are supposed to be on low PEs at the top of the cycle. They typically trade on 2 to 3 times PEs at the top of the cycle. ArcelorMittal's on a 1 times PE. And when we know the risks of these seductively low PEs towards the top of the cycle, but, sometimes how much is too cheap, just too cheap. And it's not an easy one to answer. But again, just final point, we do always just have to be careful of these seemingly low PEs somewhere towards the top of the cycle on these types of companies.
Great. Seleho, maybe you want to move on to trying to get this into the 1 hour time period, into the bulk and base metals. I think
Sure.
the big issue for me, and I think what's happening in these markets, is you've got fears of a global slowdown and a recession, which ultimately is, all else being equal, very bad for commodity prices because it would imply less demand. But on the other side of it, you've got China, which is in fact stimulating, and they're trying to get the economy growing, and they're doing the opposite of the States. So you kind of got this tug of war between global recession and Chinese stimulus. And at the moment, the last few months, the recession camp has won. Iron ore's come off quite a bit. But maybe take us through your thoughts, Seleho.
Yeah, sure. I think if you look at this table, you can see that it's I think James said that we're moving into a bit more of a stock pickers market for resources. And I think you really see that with the diversified miners. if you look on maybe if we can go to the next slide, Pete, you can see here that they vary quite substantially in terms of their exposure to different commodities. Iron ore, by some distance, is the biggest contributor to profitability. But for example, something like Glencore actually has no iron ore exposure in their business, or South 32. And you can see Glencore has been year to date the top performing diversified miner. I think largely because of this lack of iron ore contribution. And so really the big question for the diversified mining sector locally is what's China going to do in the second half of the year? You kind of hinted at stimulus. That seems to be the consensus, certainly that we've seen from sell-side participants in terms of the stuff they're putting out. If we go to the next slide, you can see that iron ore last year had an outstanding year. It averaged $161 a ton, which was its second best year on record since 2011. So it was always going to be difficult to kind of grow off of that base. But what's hurt it on top of just the high base from last year's, obviously we had this zero COVID policy out of China, and Chinese growth has been quite weak in 2022. And so now we're sitting at roughly $100 a ton. And the question is, what's going to happen? Yeah, there we are. We're at about $100 a ton. Actually a decent price for iron ore, but compared to where we've been, obviously it's quite a decline. And on the next slide, if we look at if we look at the relationship between iron ore and fixed asset investment, so fixed asset investment is the major contributor to Chinese GDP growth. That's generally how they stimulate through construction projects. So that's in the blue or the right-hand side. That's showing the percentage growth in fixed asset investment for the Chinese economy. The point to make here is that there's generally a relationship between the two. As China stimulates, you see iron ore prices pick up. We saw that in 2021. They stimulated quite substantially at the start of the year. Iron ore prices picked up. There were also supply issues. Now the question is, are we going to see a repeat of that stimulus in the second half of the year? That seems to be the base case, is that we'll get some pretty substantial stimulus in the second half of the year. That said, as James said earlier, we wouldn't be banging the table saying that this is a time to be massively overweight or over one's skis for diversified mining. We think that the risk-reward ratio is kind of balanced. We think energy is probably a bit more interesting, Thungela and some of the other companies there, but diversified mining is a bit more balanced. Just to give an example, Anglo today came out with half-year results. Their earnings were down about 30%. And we think second half earnings will be lower than first half earnings. So it's quite a tough space that they're in at the moment, although we should see stimulus. If we go to the next slide, Pete, we can look at, so I think this is interesting. This is what James touched on this in terms of 2015 being a great buying opportunity. What this slide shows is the amount, if we start with the image on the far left, it shows the amount of capex that the sector put in. So this is from Glencore. The sector as a whole invested $1 trillion of capex between 2003 and 2015. So just massive supply growth. And you see that in the middle with supply coming up. Eventually that led to commodity prices coming under pressure as we had excess supply. And as a result, earnings or free cash flow actually became quite poor. They didn't get a good return on that capex. So incidentally, the whole sector overinvested at the same time. As we sit today, we're in a bit of a different situation. So we don't see that same supply response that we saw leading up to 2015, where everyone was overinvesting. If anything, I think those memories are still pretty fresh in maybe some of the executives' minds and investors' minds. And so capex growth is pretty muted. So we think supply growth isn't the major issue for these diversified miners. We think we're more worried about demand. It's more about how strong Chinese demand will be going forward, rather than what's going to happen to supply. So although we said it's not a time to be banging the table, we are, I would say, maybe neutral on diversified mining, because we don't think that, for example, we're going to see massive amounts of additional iron ore or copper coming into the sector. So I suppose history doesn't repeat, but it does rhyme in some way. There are some similarities, but it's more demand this time that we're worried about.
One of the themes and stories that comes and goes, you've got these kind of economic fears, and then these kind of great stories for certain commodities. And I think one of the things we're seeing in this presentation is very different outlooks and different drivers for different commodities. The whole copper story, where the renewable energy, the copper that's required to feed into it, electric vehicles, etc. James, maybe to say to you, you hear these stories where can you suddenly become a long-term holder of something that's exposed to those kind of new drivers? Or is a commodity cycle always a commodity cycle?
Yeah, look,
copper was very excited and suddenly it's fallen off a cliff.
Yes. Look, I think there's always that cyclical and secular story. I just think no matter how much of a compelling secular story there is on commodity, there will always be cycles around that. To me, copper is just such a useful metal that you just cannot ever sort of really substitute away. And, just as the world's sort of insatiable demand for just energy and, data centers and electric vehicles, et cetera, you can't see the demand for copper going anything other than up. And just remember, as the chart shows you, I mean, these major discoveries have just kind of got less and less as the years have gone by. A lot of these big mines that, BHP and Rio are mining and that have actually been in production for decades, never mind years. So, copper is, I think we can say there will be a cycle, but it certainly is a very, very robust commodity for the long term. And if you were investing in any diversified miner and 20% of your earnings was coming from copper, you would be very happy with that. It certainly is one of the better commodities out there on the demand and supply front, but there will always still be a cycle.
So Seleho, based on this, that's we buy Glencore for that.
Yeah, Glencore does, within the SA context, definitely has a very unique set of commodities. It's also got quite a big trading business, which is listed there under marketing. It's about 27% of operating profit last year. Glencore, if you want copper exposure locally or on the JSE, Glencore is probably the best company to go for.
Okay, then let's round it up with platinum group metals and precious metals, really.
Yeah, so as you said,
so before you start, we're going to round this off in a few minutes. Please just post questions in the Q&A if you want us to address it. But Seleho, maybe if you can just take 5 minutes going through the dogs of the sector at the moment.
Yeah, it's amazing how quickly things change, Pete, because just a couple of years ago, PGMs were really knocking it out of the park in terms of earnings growth, coming off a very low base of their own. It seems to me as if 2021 was the peak year in terms of earnings for the sector. So we're sitting in a situation where, as James said, the PGMs almost look seductively cheap. So they're on kind of, let's call it 4 or 5 times PE multiples. That looks very cheap and on the face of it. And in some cases, they're paying a lot of those earnings back in dividends. For example, Amplats, if you annualize the dividend they announced this week, it's like a 12% dividend yield. So it looks very cheap, but we're pretty cautious on PGMs. We're meaningfully underweight the sector. And that's just because we think there are headwinds in terms of the major parts of the PGM basket. So that's rhodium and palladium mostly. Those two metals are about 70% of the PGM basket. As we said earlier, auto demand is really the big driver for these two metals, for rhodium and palladium. It's over 80% of demand for these metals. And I suppose the issue is going into what looks like it's going to be at the very least an economic slowdown, probably a recession. Do you want to have major exposure to a metal where auto demand is really the big source or end use? we've already spoken about what the prices have done year on year. I think what's interesting is auto sales or production year to date have been okay, but analysts have actually been upgrading their numbers for 2022. So it looks as if when we end the year, we should be at around 4% growth for auto production, which I think would be a good outcome for the PGM sector. Another big part of this hinges on what happens with China in terms of the lockdowns they go through, because they're a big source of car demand. And then another thing that's affected the sector has been the chip shortage. So initially, the market was thinking by the first half of 2022, we'd see an easing in chip shortages. Now, perhaps, hopefully, we're looking at the second half of this calendar year of 2022. But really, these are the big drivers. It's auto demand for the most part, and how much we see in terms of auto production growing. So to repeat, hopefully not to repeat myself too much, but we're pretty cautious on PGMs as a whole. We think that they're cheap, but we're worried about that E number not being sustainable.
I'll just throw in one thing here. I mean, I've never directly covered these PGMs myself. I always had a colleague who did that. But if I think back over my career, this is probably the best example of a sector I remember where investors got absolutely killed on this low PE, high dividend yield argument. And I'm subject to correction on the exact year, but I think it was somewhere around about 2000, where the stocks had done really, really well over a few years. They were on 5 PEs, sort of 10% dividend yields. And everybody said, look, their stocks have done well. We know earnings are high, but, we're really protected by these low PEs. And in the meantime, we'll just pick up our 10% dividend check. And, doesn't happen every time, but people got absolutely smashed on that argument back then. It didn't protect the companies at all.
Let's go through to a few questions. James, what's your opinion on where we are in the current commodity cycle? And then if China opens up completely, what will the effect be on base metals? I think we've kind of got Seleho's view. Maybe a thought on it.
Yeah, so again, I suppose maybe back to my earlier comments, it feels to me like we somewhere around that sort of midpoint in the commodity cycle. It's far, far from being a classic buying opportunity. But things have pulled back quite nicely. So, I don't think you'll be making a mistake by having some mining exposure now. It's certainly not as expensive as things were earlier. But so I'd say, again, I'm also just probably somewhere in that neutral camp.
Seleho, Tungela, there's always going to be questions about a share that's gone up 200% in the year. It's hitting new highs today. What's your expectation of the sustainability of earnings and dividends going forward?
So we don't think that, they're earning about 20 Rand per month. It might be a bit more given what coal's done recently, but about 20 Rand per month per share at these coal prices. So it's on a PE of roughly just over 1 times. We think that they're likely to pay the majority, kind of 80-90% plus of what they earn back as a dividend. So we think that in the first half of, when they announced first half results, our estimate for the dividend that they declare is it's about 50 to 60 Rand. But obviously since then, coal prices have picked up quite substantially. So we think that they have a cash buffer target and they're well above that target. We think that they'll continue to pay out what they earn as a dividend. But in terms of medium to long term, we don't think that these coal prices are sustainable, but they can last a bit longer than maybe us in the market had initially expected, given what's happening in Europe and the conflict between Russia and Ukraine and where natural gas prices are and kind of the energy shortage or issues they're having there.
I think if you speak to the SA coal miners, they haven't spoken to Italian electricity producers for years. And suddenly the guys are over here trying to conclude coal supply contracts. Because if they can't get Russian gas, they're turning back on power stations. And that's really the root of the story in the very short term. So there's buyers of coal who weren't buyers of SA coal any time in the past. And a lot of our stuff's going through into Europe. So 20 Rand per month. If it stayed at this price, that's kind of almost the share price, 240 Rand in a year. But, just to remind you, and hopefully it's come through in this presentation, commodity prices can be very cyclical. So the close to 400 Rand coal price $400 can be $80 in 12 to 24 months time, if things get normalized and things get replaced. And then a question I'd pose to both of you: if I look at the decline of the copper price, it looks like a big economic downturn is on the way. Or is it just temporary and we'll see a rise in the copper price? I think we've partly covered that, and it falls into quite a few themes, but maybe James or Seleho's got a comment on it.
I just still think copper will come back. As I said earlier, it's a good commodity. It's got a very, very good, robust long-term demand profile. Your substitution risks are really low. It's hard to envisage a scenario where the world needs anything other than just increasingly more copper over time. Just such a useful metal. Supply, you're just not going to suddenly discover some massive new deposit overnight that nobody knew about. And even if you did, your lead times are long. I mean, I see Anglo just bringing that Quellaveco copper mine into production now. I remember when I started looking at Anglo in 1994, they had that mine as one of their copper projects. So that's how long it's taken them. For whatever the reasons were, whether it were political issues and all the rest of it, your lead times are very, very long. So, yes, notwithstanding the cycle, those cycle will come and go. Nobody really knows where that will end up. But long-term copper, I just still think it's not in a bubble. I think that's, whereas thermal coal could be in a bubble, copper is not in any kind of bubble. So I'm very, very comfortable with that long-term.
Fantastic. Yeah, okay. Thanks, guys. We've gone. Sorry, Seleho, do you want to add to that?
Sorry, I was just going to say, the Freeport CEO said a couple of months ago that, or might have been end of last year, that if copper was at about $10,000 a ton, which would be, prices quite a bit higher than where we are now, it would still take them 7 to 8 years to bring new supply on. So it's almost regardless of price, the lead times are quite long, as James said. I do think that they call it Dr. Copper, and I do think that the price maybe is telling us something in terms of an economic slowdown or recession, but I fully agree with James that the long-term outlook for copper demand is very positive.
Okay, guys, we've got to the end of our time slot. Thank you very much to James and Seleho. I think
thanks, everyone.
Some great wisdom there from a commodity cycle perspective. This recording will be made available to you. You can contact Dale or your contact at Anchor. But if you want to close it up, Dale.
Yeah, Pete, just a very big thank you for hosting. You did a superb job. I think it was wonderful to see the interplay between all three of you. And to all of you, it's been a wonderful turnout today. Clearly we hit a good subject matter. We look forward to seeing you next month at Essentials. Bye.